The webinar will begin in about 1 minute. Welcome everyone to this month's free webinar sponsored by Advanced Underwriting Consultants, AUC. I am your host today, Linus Sugis. The consultants at AUC, including myself, we get questions about issues related to taxes, life insurance, retirement and financial products, small business ownership and succession, and estate planning issues. We hear about issues from your perspective, and today I plan to present information about the new federal business income tax rules and the proposed regulations that were recently published by the IRS. And the information we present to you is from a perspective that we feel is important for you to know in your businesses. And so at the end of today's session, we hope you'll agree that it was valuable, and you'll also hear about how to get supporting materials and also how to send questions related to today's content emailed to you. This month's webinar is on the new proposed regulations. If you join us next month, you'll have the opportunity to hear about 10 Shades of Gray, the tax risk continuum. All of our webinars are posted to our YouTube channel, including today's content, which should appear on our YouTube channel before the end of this week. We're going to spend the next 15 minutes or so taking a brief overview of the IRS proposed regulations with a little bit of background on some of the business income tax changes. If you've got more questions about the Tax Cut and Jobs Act overall, check out some of our prior webinars, which are available on our YouTube channel. So, as a quick review, the Tax Cut and Jobs Act was signed into law in December of last year. The process was hurried. It was primarily a Republican initiative. Input of Democrats was not sought, and the process happened in a relatively abbreviated period of time. Since the enactment of the Tax Cut and Jobs Act, most of us who work with closely held business owners, either directly or indirectly, had been eagerly awaiting regulations from the IRS on new code section 199A, which is the pass-through business deduction section of the tax code. Section 199A creates a new 20% tax deduction for the income of certain kinds of pass-through businesses. And a lot of the particulars of how that was going to work, those particulars were left vague. And fortunately for us, a few weeks ago, the IRS issued proposed regulations on Section 199A. The IRS has invited commentary on the proposals, and there's a hearing scheduled next month for the comments and the regulations. And the IRS hopes to publish final regulations sometime after the hearing. We'll see whether we get those regulations this year or perhaps as late as sometime early next year. So in the way of review, Tax Cut and Job Act creates a new 20% tax deduction for the income of pass-through businesses, certain kinds. What's a pass-through business? We're talking about S corporations, partnerships, or proprietorships. I've talked about this to groups before, and usually somebody asks, well, what about an LLC? Well, an LLC has the ability to choose to be taxed like an S corporation, partnership, or proprietorship, depending on whether there are one or more members, or a C corporation. So an LLC, if you know a business is an LLC, you've got to ask the next question, well, how is your LLC taxed? You've got to ask that of the business owner to know whether it is a pass-through entity or not. For those LLCs that are taxed as partnerships, proprietorships, or S corporations, these new rules about the 20% deduction also apply to them. The 20% pass-through deduction is not available for every kind of pass-through business. There are limits on the amount of income that a business can have, and there are also other kinds of limitations that come into play. Well, how do those work? Here's how they work. If you're the owner of a pass-through business, and if you're single, and if your taxable income is below $157,500 in 2018, then you will qualify for the pass-through deduction no matter what type of business you've got on all of your qualified business income. And we'll talk about what qualified business income is a little bit later. But if you're below the threshold and you've got a pass-through business, it doesn't matter what kind of business you're engaged in, you get the benefit of the pass-through deduction on your qualified business income. The taxable income limit goes up to $315,000 for taxpayers who are married filing jointly. Now, that's not just business income, that's your overall income. If you're above the threshold, it becomes a harder question as to whether you qualify for the deduction. So, and as I said, it doesn't matter what kind of business you're in, you qualify for the deduction. Even if you're in a kind of a personal service company, you still get the deduction if you're a pass-through business. If you're over the threshold, you become either partly or fully phased out if your business is a specified trade, a specified business or trust kind of business, personal service kind of business. Those involve the performance of services in health, law, consulting, athletics, financial services, brokerage services, etc. The IRS has told us more specifically what kind of businesses fall into that category. So if the owner is over the threshold, those types of businesses will either be partly or completely phased out of the deduction, no matter what the other circumstances are. And if a pass-through business is not engaged in the specified service or trade business, if they're over the threshold, they may still be able to get the full amount of the pass-through deduction if certain requirements about assets or W-2 income are met inside the business. So a lot of the uncertainty around how much the deduction might be had to do with what is qualified business income. And the uncertainty was related to exactly what type of pass-through entity the business owner who was seeking the deduction was engaged in. And it's a bit counterintuitive, but certain kinds of pass-through businesses were more advantageous for the purpose of the deduction than others. For example, if you had a business owner who made $100,000 $1,000 worth of profit in the business and was otherwise eligible for the pass-through deduction because they were below the threshold, the question is how much of that 100 grand would get the deduction. Normally you'd expect it to be 20 grand. But that's not necessarily true. It was different depending on whether the business is organized as a proprietorship, an S corporation, or a partnership. So the regulations or the law and the proposed regulations seem to make clear that all of the time in a sole proprietorship, whatever the sole proprietor's profit is in the business, it is entirely eligible for the 20% deduction. There is no adjustment for a fair wage for the proprietor. All of the business income is eligible for the deduction. In an S corporation, conversely, you have to subtract out the compensation, the salary that the S corporation owner is paid or should be paid. So the proposed regulations make clear that whatever wage is paid to the S corporation owner as an employee, or whatever wage should be paid to the S corporation owner as an employee, even if the wage wasn't paid, that needs to be subtracted out of the business income before you take the deduction. So in the example, if there's 100 grand of business income, but you should pay the S corporation owner 50 grand as a salary, then only 50 grand is eligible for the 20% deduction. So of course it becomes tricky in determining what an S corporation owner should be paid. The IRS wants to impose reasonable compensation rules under those circumstances. And they haven't told us exactly how reasonable compensation ought to be determined. And so it's going to be up to the client and the client's accountant to figure that out if you've got an S corporation structure. So in an S corporation, if you've got an owner who is active in the business and ought to be paid or is paid as an employee, if you compare that directly to a proprietorship, an S corporation gets a smaller pass-through deduction than a proprietorship does. So what about partnerships? Well, in partnerships, the answer is a little bit more ambiguous. In partnerships, there isn't a wage adjustment that must be made, but the proposed regulations say that you need to make a downward adjustment on partnership profits for any guaranteed payments that are paid to partners. Guaranteed payments are a partnership only kind of thing. It would be good if you know that you've got a business that is structured as a partnership to have the owner go talk to their CPA to make sure that the partnership is not making guaranteed payments to partners unless there are strong non-tax reasons to do so, because those guaranteed payments to partners will be subtracted out of the partnership income before you can claim the 20% deduction. Guaranteed payments are not part of qualified business income that is eligible for the deduction. So those things are a little bit tricky. They were kind of set in stone by the proposed regulations, and we may or may not see some changes to those prior to the final regulations. So if you've got a business owner in a pass-through business that's over the threshold, that business owner may still be able to claim the pass-through deduction only if the business owner is not engaged in essentially a personal service business, and if there's enough W-2 income or depreciable property in the business to generate the deduction. You can see a description of the formula on the slide. I'm not going to go through an example because I think it's confusing, but understand if you've got somebody who's not in a service business who's over the threshold, they still may be able to get through the pass-through deduction, and their ability to take the deduction will depend on how much wage they pay out and how much depreciable property they have in the business. Here's a quick example. As I said, I'm not going to go through it. We don't really have enough time, but understand that the pass-through deduction is available with regard to certain kinds of businesses. So I mentioned earlier that the regulations talk about what is a specified service, trade, or business. These are referred to as SSTBs. For business owners over the threshold, their ability to take the pass-through deduction is either phased out or eliminated completely. The code itself talks about specific things, services in the fields of health, law, accounting, actuarial science, financial services, investment management, where the principal asset is the reputation or skill of one or more of the employees. And so it seems clear that lawyers are out if they're over the threshold, accountants are out if they're over the threshold, and financial services businesses are out if they are over the threshold. What was not clear is where somebody is exclusively involved in the insurance business, whether they would be out or not. And we did get some direction in the regulations. They gave some specific examples of healthcare before we get to financial services and insurance agencies. Healthcare, the proposed regulations specifically say activities around doctors, nurses, dentists, physical therapists, veterinarians, those are healthcare businesses. Non-SSTBs, health clubs, or drug research. Law, if you're a lawyer or paralegal and you're doing those kinds of services, you're clearly within the definition of SSTB, and if you're over the threshold, you don't get the pass-through deduction. On the other hand, if you're a stenographer, if you're selling court transcription services, the proposed regulations say you're not an SSTB, and so that business, that pass-through business, is potentially eligible for the deduction. Specific examples about accounting, specific examples about consulting. Consulting, for the most part, is going to be an SSTB. Financial services and brokerage services, this is interesting, includes services by stockbrokers and other similar professionals, but does not include the services provided by real estate agents and brokers or insurance agents and brokers. You would think by looking at that part of the proposed regulation that if you've got an insurance agency, you're going to be in the clear, you're going to be able to get the pass-through deduction. But that's a little less certain because of the next little bit that we're going to talk about. And so this is a situation provided by the regulations where the IRS said, well, what if a business provides some services that are non-SSTBs, but they provide other services that are SSTBs? And the answer is that if 10% of what you do, 10% or more of what you do is an SSTB, your business doesn't qualify. It's out. If you're over the threshold and 10% of what you do is financial services, and you're an insurance agency, but 10% of what you do is financial services, you don't get the deduction if you're over the threshold. That's the clearest example that we've got. Now, for a lot of our clients who are in mixed businesses where some of their stuff is personal services, SSTBs, and some of it's not, whether they're above or below this threshold of 10%, it's going to be important to kind of make that determination. But just 10% of your effort, if it's SSTB, under the regulations, you are an SSTB, and your ability to take the deduction is going to be severely curtailed. Some of the questions that people were asking is, could they carve their businesses into separate parts so that some activities are non-SSTBs and others are SSTBs? And the answer is the regulations make it really hard. The regulations say that if you're a doctor's office, for example, and you try to put your medical practice in one kind of LLC, but you try to put your billing and your reception services in a different entity, you'd think that you might be able to put your administrative services outside of the scope of SSTBs. But the IRS says that if those entities are under common ownership, and their common ownership rules are pretty complicated, but if they're under common ownership, they're going to mash those entities together. And under most circumstances, you're not going to gain anything by separating out the businesses into separate businesses. All of your businesses are going to be considered SSTBs, and they may preclude you from being able to get the deduction. So the rule is 50% common ownership, either directly or indirectly, and if they provide 80% or more of their services to one SSTB. So the doctor's example is a perfect example. The services would be provided to SSTBs, and probably 50% or more direct or indirect ownership. And so in that kind of an example, the administrative LLC would be lumped into the doctor's practices, and so the availability of the deduction would probably not be available in that kind of example. Now, I'm not saying there aren't situations where certain kinds of activities might be carved out into different ownership, but it's going to be hard. The proposed regulations make it hard to run down that path. Now, to wrap this up, let me make a couple of observations. I mentioned earlier that the service has asked for comments, and they're going to hold a public hearing on the proposed regulations next month on October 16th. Clearly, this is the direction the service intends to go with how they're going to administer a new Section 199A. And so it seems unlikely that there are going to be major changes to the proposed regulations. Of course, we'll see, but that's where it's going to be. It's hard to imagine that the service is going to publish final regulations much before the end of this year. Perhaps it'll be next year. Makes it hard for our clients to plan, so they better start thinking about it now. If our business owning clients haven't yet had a conversation with their CPAs about how best to manage and maximize their eligibility for the pass-through deduction, the time couldn't be better. And you couldn't have a better opportunity than to touch base with your business owning clients to make sure they're having those conversations. If you facilitate those conversations, not only will you look good for your clients by making sure that they save as much tax money as they can, you're also going to look good in front of their CPA, because the CPA probably needs or probably means to be having these conversations with their business owning clients, but maybe hasn't made it a priority. So your timing couldn't be better in that regard. So that's it on today's topic. If you've got questions about today's topic, or if you want to get a copy of the newsletter, which covers much of the ground that we talked about in today's session, feel welcome to email us at asktheexpert@advancedunderwriting.com. That's asktheexpert@advancedunderwriting.com. You will be able to find a replay of today's session through our YouTube channel. Please make sure that you subscribe. Subscribing certainly helps us know that you're interested in our content. If you've got questions about what's there, feel welcome to email there. And please plan to join us next month when our topic will be 10 Shades of Gray, the tax risk continuum. Thanks again for joining us, and best wishes for continued success.